Spousal loans, moving investable income to the less taxed spouse. Did you know that there's a legal way for high-income earners in Canada to reduce their family's overall tax bill without bending a single rule? It's called a spousal loan. And when used properly, it can shift investment income from a higher income spouse to a lower income one, saving thousands in taxes. In today's video, we'll walk through how this strategy works, what the Canada Revenue Agency requires, and what makes it effective. We'll also break down real examples so you can see the potential benefits for yourself. Welcome to the channel. My name is Anthony Gismondi. I'm a Senior Wealth Advisor at Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. A spousal loan is a legal tax planning strategy in which a higher income spouse lends money to their lower income spouse. The funds are then invested by the lower income spouse, who reports the investment income at their lower marginal tax rate. By shifting income in this way, couples can reduce their total household tax burden, provided the arrangement complies with Canada Revenue Agency guidelines. For a spousal loan to be valid in the eyes of the CRA, the following conditions must be met. Number one, there's a prescribed interest rate. The loan must carry interest at the CRA's prescribed rate at the time it is issued. This rate is set quarterly and can be locked in for the life of the loan. Number two, annual interest payment deadline. The borrowing spouse must pay the lender spouse interest by January 30 of the following year, every year. Even 1 day late triggers the attribution rules, nullifying the tax benefits. Number three, use of funds. The loan funds must be used to purchase income-generating investments. Using the money for personal expenses disqualifies the strategy. Number four, documentation. A written loan agreement and promissory note are required. Records of interest payments must be maintained. Why not just gift the money? You might wonder, why not just give money to your spouse and let them invest it? The answer lies in the attribution rules, which prevent income earned on gifted funds from being taxed in the hands of the lower income spouse. Spousal loans, when properly structured, are an exception to this rule. Components of the strategy. There are several important components to properly implementing a spousal loan strategy. One, identifying assets. The higher income spouse must identify non-registered capital that can be lent. Cash, business sale proceeds, or inheritance funds. Number two, loan structure. Create a formal loan agreement and promissory note. It's recommended the transfer happen between individual accounts, not joint accounts. Three, investment portfolio. The lower income spouse should invest the funds in a portfolio expected to yield more than the prescribed interest rate. Otherwise, the strategy may not generate net tax savings. Four, annual interest payment. The borrowing spouse must make timely interest payments with their own funds. Five, tracking and review. Regularly review the loan's performance and ensuring ongoing compliance. Prescribed rate and savings example. Two comparison scenarios, minus 2% versus 3% prescribed rate. Let's look at a simplified example. Suppose a high-income spouse, taxed at 50%, lends $500,000 to their lower income spouse, who's taxed at 25%. The investment earns a 5% return, say $25,000 a year. At a 2% prescribed rate, lower income spouse pays $10,000 in interest, 2% of the $500,000, then reports $25,000 of income, deducts $10,000 of interest, the net taxable income, $15,000. Tax of $3,750, which is 25% of the $15,000. The lender spouse pays $5,000 tax on the $10,000 interest income. The total tax works out to $8,750 versus $12,500 if all income taxed in high spouse's hands. That works out to an annual tax savings of $3,750 at a 3% prescribed rate. So now your interest payment rises to $15,000. Net income drops to $10,000. Total tax payable by both spouses, $10,000. Lower savings than at 2%, demonstrating the advantage of acting when the prescribed rate is low. Benefits of the strategy. The main benefit is maximizing after-tax income for the family by reducing taxation on investment earnings. Over several years, the savings compound, particularly when the loan is established during a low period of low prescribed rates and long-term investing. In one example, a $500,000 loan at a 1% rate produced $23,000 in tax savings over 10 years. Let's talk about tax considerations. There are also several tax-related factors to consider. Interest deductibility. The borrowing spouse can usually deduct interest payments as long as the borrowed funds remain invested in income-producing assets. Debt forgiveness. If the loan is forgiven, example due to loss or estate issues, complex debt forgiveness rules apply and may create unexpected tax liabilities. Estate planning. The loan must be addressed in wills and estate documents. Upon death, the loan becomes a debt of the estate, which could trigger probate and capital gain implications. Costs and practical considerations. Implementing a spousal loan strategy involves administrative and professional costs. Legal fees to draft and review loan agreements, time spent maintaining documentation and tracking payments, potential accounting fees to report interest properly on both spouses' tax returns. These costs should be weighed against the expected tax savings. In summary, spousal loans are a powerful and legitimate income splitting tool when implemented correctly. They require legal documentation, consistent compliance, and investment discipline. However, the long-term tax savings for high-income families can be substantial. If you found this video informative, feel free to like, subscribe, and leave a comment below. For personalized advice, always consult with a qualified tax or financial advisor.